Warren Buffett, known as one of the greatest investors of all time, is holding an all-time record amount of cash after selling stocks like Apple and Bank of America, and many are sounding the alarm. But should you take this as a warning shot to protect your retirement investments? This is not a fear video, it's also not a prediction video. In 2021, the stock market was doing quite well, and we wrote a blog post about how to prepare for the next bear market to protect your retirement. That post was not a prediction either, but as we now know, the steps to prepare were needed sooner than we would have liked when 2022 hit. In this video, I'll show you what you need to understand about the stock market and Buffett's protective position and how to prepare for the next bear market before it occurs. Let's get right into it. Before we can prepare for the next bear market, we must first understand what most people miss when they see a famous investor do something out of the ordinary. See, Buffett's defensive position is not a random action on his part. There's a ratio now famously known as the Buffett Indicator, which simply divides the value of the US stock market by a nation's GDP. Well, it's at a historically high level, which would indicate that the stock market is overvalued, leading some to believe that a market drop is coming. Well, even leveling this out for the fact that the stock market historically increases over time, it still indicates an overvalued position. Berkshire Hathaway, Buffett's company, sits with $325 billion in cash as of Q4 2024. And even when we account for Berkshire just being a much bigger company nowadays, that cash position relative to total company assets is historically high. But it is that size of Berkshire which should give us ordinary investors some pause. It's now one of 8 trillion companies in the US. And for Buffett to move the needle on the company's investments, he would need to make a big splash, which means he needs the cash. Buffett has said the ordinary investor should not shy away from broad stock market exposure like the S&P 500. But Buffett's in a different category. He's not all too concerned with dollar cost averaging into his 401k, so a large cash position is opportunistic, and Buffett's success can be attributed to time in the market and patience. And we need to understand two things about the stock market before we can correctly prepare for the next bear market. You see, the stock market drops by 5% once per year on average. So that negative on your account statement is more often a small dip than the beginning of a major decline. That said, bear markets, categorized as declines of 20% or more, occur about every 6 years or so. But that calendar is inconsistent and uncertain. Capital Group, which published this chart, provides the following key takeaways. And I'll drop a link in the description to all the resources I'm going to mention through this video. Number 1, no one can predict consistently when market declines will happen. Number 2, no one can predict how long a decline will last. Number 3, no one can consistently predict the right time to get in or out of the market. Now, you may be thinking, well, yes, we've had a lot of run up in the stock market. Even with 2022, we're at all-time highs. We must be due for a bear market. But here's the second thing. History would tell us that reaching an all-time high doesn't mean an imminent decline in stocks. Ben Carlson points out that going back to 1950, 7% of all trading days were at all-time highs. That is one new high every 14 trading days or so. That's hardly an abnormal reality. I love what Ben says. He says, if you're nervous about investing at all-time highs, maybe you shouldn't put all your dry powder to work in the stock market. My general rule of thumb is you should only invest in the stock market an amount you'd be willing to hold through both bull and bear markets. No one can predict when stocks will take off or get crushed, so your asset allocation should take that into account. And since we don't know the time, I'm going to give you 6 things you can do to prepare your retirement portfolio for the next bear market without a fear-based response and without trying to heroically time your 100% go to cash moment. This way you can prepare, but still hope that the stock market increases. So number 1, from a financial perspective, what probably helps people sleep best at night when the investment markets get rough? That's right, I think it's having cash. But be purposeful with this amount. Even with interest rates higher than in years past, cash has not performed best for long-term holding. Consider having an accessible emergency reserve, and if it's not the same account, having maybe a year's worth of income in high-interest cash funds. And this allocation can still be kept in your IRAs or a brokerage account. Number 2, and this can be your next layer coordinated with cash, having bonds in your investment portfolio. But I need to point out that bonds come in varying durations and quality. All bonds are not the same, so know what you're getting into. As an example, 2022 was historically bad year for bonds when interest rates just screamed higher. Well, this chart compares Vanguard's short-term Treasury ETF to iShares' 20-year Treasury, which is long-term. Now, both were negative, but the difference was massive. And because stocks were negative during this time as well, the last thing you want is your bonds to fall so much. So our preference is high quality. Think US Treasury and high-grade corporate, and for length, short to intermediate term for your bonds. This creates more of a barbell approach to let your stocks and your growth assets take on the risk and aim to get that long-term growth, while the shorter-term bonds and the cash are purposefully conservative. This way, if and when that bear market hits, your cash and bonds can keep your income uninterrupted while you wait for stocks to recover, rather than selling them when they're down 20, 30, or 40%. I'll share more on how to manage withdrawals from your investment portfolio in a severe market downturn toward the end of this video when I tie it all together, so hang with me. Number 3, and this is where you don't want to pin yourself in a corner. You want to understand the timelines of your expenses, particularly bigger, out of the ordinary expenses. This is why your financial plan needs to be coordinated with your investment plan. Here's what I mean by that. So let's just say you're buying a car next year and you have $30,000 set aside to buy that car. Well, that's great. But even if you're fully optimistic on the stock market, that would be an ultra risky bet to have that money you need soon in a risky asset like stocks. For those larger purchases, understand when you need the money. Shorter time frames, well, consider more conservative, stable ways to earn some interest so you preserve your principal and the money's there when you need it. Number 4, when the stock market's good, let's say your original target for stocks is 70%. Well, that could become 80% simply because your stocks perform much better than bonds and cash in your portfolio. This leaves you more aggressive than your plan. So we rebalance by taking risk off the table in this example and simply bringing the percentages back to their targets. You're taking your profits. This then helps to minimize losses when that down stock market occurs. Now, this solution can be applied in the opposite direction. I remember rebalancing our clients to be buying stocks after the COVID downturn in 2020 and riding that recovery up. But what's the best way to rebalance? Well, Michael Kitces wrote a great piece comparing the optimal frequency and the method to rebalance, either on a calendar basis or based on the amount of drift from the target. So you can use either. The calendar method is usually easier and can even be set automatically in most 401ks nowadays. Kitces references Vanguard's study that shows annual rebalancing works just fine, as risk and potential trade costs were less and returns were about the same as compared to if you did it monthly or quarterly. The drift method is what we prefer to use in managing our clients' money. We also have the technology to monitor this. As Kitces says, the goal again is to set a threshold that's far enough out to allow investments to run near extremes, but not so far that they run to extremes and bounce back again without ever triggering a buy or a sell trade. So the optimal rebalance band is at 20% above or below your target percentage. So for example, if you have 50% in a US stock fund, it could go up to 60% or down to 40% before it would trigger a rebalance. And optimally, these thresholds would be monitored very frequently. But don't let perfecting your method get in the way of just doing it. Number 5, we've talked about diversification with traditional asset classes, but how about holding investments like gold or Bitcoin? Certainly the principle of diversification is relevant to our topic because spreading out your investments, not having all your eggs in one basket, can serve you well. If stocks are down, well, maybe these alternative asset classes are up. But are popular assets like gold or Bitcoin really worth it? Or in the case of Bitcoin, is it just a fad? That's a whole video or maybe even a whole series of videos in itself. At this point, you can put me in that agnostic crowd, at least when it comes to Bitcoin. To me, it's difficult to understand, potentially leaving me to feeling like a chump either way. So will it help you? Maybe, and that's for you to decide. The purposes and methods of holding Bitcoin are many. Now that ETFs track the price of Bitcoin, it can make for an easy way to gain exposure within your retirement accounts. But just seriously consider the massive fluctuation potential of an asset like that and factor that into how much you may or may not hold. Number 6, timing the market doesn't work. I mean, trying to catch the bottom or the top is really a losing battle. Even if you get out in time, you have a second decision of when to get back in. But what if you can minimize the downside when the stock market's in one of those free falls? That's where this solution comes into play. But it doesn't work all the time. Let me explain. See, my favorite baseball player of all time, being from San Diego, is the late, great Tony Gwynn. He's considered one of the best pure hitters ever. Gwynn's .338 batting average is the highest in the expansion era of baseball. Amazingly, and I love this stat, Gwynn could have gone hitless, striking out every single time for the next 1,182 at-bats, and would still have a better batting average and strikeout percentage than the great Derek Jeter. But even as a .338 hitter means Gwynn got out more than 65% of the time. That's baseball. But a statistical way to protect against major market declines is through trend investing. In our firm, we call it tactical. It simply uses statistics to determine when to reduce exposure to a certain asset class like US stocks or international stocks, and when to get back in. The idea is to avoid or catch the trend. For example, we can see that in 2008, US stocks were trending downward. This blue line, which I'm showing you on the chart, was below the orange trend line, therefore you go to cash. Well, alternatively, in 2009, US stocks were trending upward. The blue line was above the orange trend line, as you'll see in the chart. Therefore, you'd get back in US stocks. It sounds great, but you may remember what I said before. The stock market more frequently has small dips than large crashes. So in those situations, you can get whipsawed out or in at the wrong times using trend. But even though it's not a silver bullet, the academic research shows that risk-adjusted returns can be worthwhile for those with the discipline to follow the statistics and the willingness to deviate from the normal market. See, we believe in diversifying a portion to a low-cost, data-driven, trend-following strategy to reduce risk. I'll post some resources from our friends at Alpha Architect. Now, the most important part, because we can prepare for the next bear market, but we can't control it from happening. And when you're in retirement, the planning changes. You want to be equipped to sustain your income when adversity hits. Well, back in 2008, during the great financial crisis, our retired clients, they were willing to make adjustments to their income to better ensure long-term success. They just needed the guidance of what to do. Well, using a risk-based guardrails approach to retirement can help with this. The technology is way ahead of 2008. So let me show you a plan for John and Mary. Their retirement paycheck is $10,600 from all their income sources, including their investment withdrawals. And by the way, the principles of what I'm showing you could still apply if your numbers are different. From the $2 million that they have, they can give themselves a raise if they get their portfolio to $2,154,000. And if the portfolio drops to $1.5 million, then they need to reduce their income by $500 per month. Well, these guardrails are in place to ensure they can spend and enjoy their retirement, but also know when to tighten the belt when things get rough. Well, let's see how this played out in 2008 during that time. We can see here early in 2009, they would have needed to take a reduction of $500 per month. And that was eventually made up over time with their income. We can see down here the guardrails in action over their retirement timeframe. The risk-based guardrails approach to retirement income is my favorite, but it's not the only method to manage your retirement income. In this video that you need to check out, I compare the risk-based guardrails method to Vanguard's dynamic spending method and 2 other strategies to manage your retirement income. Now, you'll be far ahead if you have a go-to strategy. And if you'd like to talk to me and our team of CFPs about your retirement plan, we always start with a brief call. You can schedule a time by using the link in the description. Thanks for watching.